Welcome to the Daily Update. This is being prepared Tuesday, April 19th, where we'll look at the action in the market today and then see how things look for Wednesday, April 20th. And it was a pretty powerful day to the upside. To say that this was unexpected was a little bit of a surprise, but the market's just decided, okay, we've been going down, we've been going sideways, not really much has happened. We're just going to take things in a different direction today. And that's what happened. And the market ended up being up pretty strong. And with the exception of energy, was pretty much across the board strong. Now, the big question that we have to ask is this the start of a new uptrend? Are we going to see prices go higher from here? Or is this just wearing off the short-term oversold indication that we've had over the last few days? You can make a case for either side right now. So let's go through and look at the evidence and see what we can conclude. So we opened higher. It was kind of flat, but then immediately right after the open, we saw prices really start to shoot up. We broke above R1 and we even got above R2, which is kind of interesting. I actually calculated R3, but we never got that far. The way R3 is calculated since the previous day, Monday, was so tight in its range, it's calculated to the point so that it was at such a high level that we didn't really risk getting there. As the day went on, prices continued to go higher, so I'm dealing more with price levels here. We were able to get above 44.50 and then 44.60, and then we even got above 44.70 as we got closer to the close. We did close a bit off the high, and we ended up being up 1.61%, a good solid move. Did it really change anything? Well, let's go in and look at the charts and see what we have to conclude from that. Volume did increase, so that is kind of positive. Have a strong up day with an increase in volume, but it was still below average. Our technicals are still negative overall. However, I think it's safe to assume that we've worn off a lot of that short-term oversold reading. And inflation and interest rates still seem to be the concern, but on Tuesday, it was a little bit different. Interest rates went up, but so did stocks. Oil went up, but so did stocks. So it was just one of those days where a lot of the bullish folks or a lot of the people that think that they're buying on the dips, they just said, I don't care. I'm just going to jump in because I think things are going to be positive in the future. So I'm going to buy right now. A lot of the people who are negative, who are in short positions, as prices kept going up and up, they had to exit out of those positions, and they have to do that by buying. And so that pushed prices even higher. So it kind of fed into itself. And of course, we still have the same geopolitical concerns. So what are some comments that we can make? The technicals still remain negative. We have a strong day like we saw on Tuesday. That's really not going to change anything in the bigger picture. Now, it could change, but we need to see follow through from this. So was this just an attempt to wear off the short-term oversold condition? Or can this upward movement continue? Now, back in the middle of March, that's kind of how this started. Are we just going to bounce up enough to wear off an oversold condition? Well, we had a bit of a different environment then. A lot of people are going to try to compare the two. Sentiment was a bit different at that time. We were very fearful at that point, where we're still more neutral to slightly negative right now. And we saw much more coming together of signals back in the middle of March than what we're seeing right now. But that doesn't mean that prices can't continue to go higher. But right now, my personal take on this is a short-term bounce from an oversold condition. Until we see some more follow-through, we have to maintain that stance in our longer-term time frames. We were able to get back above the 200 exponential moving average and the 50 simple moving average. The 50 is probably the important one. That's the one, if you read any reports, they mentioned that. And there was actually some bad news that came out, or I shouldn't say bad news, because sometimes bad news is good news and good news is bad news and vice versa. But these were the things that came out that could have taken stocks lower. There were some earnings that came out, and there are some big companies getting set to do some earnings reports, and they were a little bit disappointing. And so the market kind of went, we're still going to go up anyway. A couple of people on the Fed gave some speeches, and especially one that's a voting member said, we're going to be at 3.5% by the end of the year. That could have easily freaked out the markets. It didn't. So that's why I do pay attention to the news. I do think that we need to know what's going on and what the different players are saying or doing. But ultimately, we have to look at our charts to tell us what's happening, because sometimes the market will react, sometimes it won't. And just about the time you think you've got this figured out and you know somebody says A and B is going to happen, and so I'm going to do C, is just about the time things move in the opposite direction. And that's kind of what we saw on Tuesday. Interest rates did climb, but growth stocks still went up anyway. Oil did decline, which sometimes that can help stocks go up. I think I said earlier oil went up, but actually it went down. But that could have helped stocks a little bit. The dollar index is still above 100 and continues to climb. So we're just watching that. And then as far as the economic reports, the housing starts report and the building permits that came out, they were better than expected. Which, again, these are not market moving reports, but the market could have fixated on that and used it for justification to go lower. You'll hear me say in my classes and in videos a lot, yeah, we pay attention to what's going on, but a lot of people think it's the news that makes the market move. And that is true to a degree. But there's also a lot of times when the market's already doing something and then we hear a news report and the market just uses justification to go in whatever direction it's going to go. And we saw a pretty good example of that on Tuesday. Our trend is still that we're in a trendless environment. Our bias is now switched to positive after the update, but our momentum is still negative overall. So let's go back, look at today's session. As far as sentiment, we actually declined a little bit. We went from 40 down to 39, but we're still in overall neutral territory. We're right on the line right there. So we can still go either way with things as far as sentiment with that chart. The VIX fell on an up day, which is not a surprise on a closing basis. And we came back down here and closed near the low, but we're still above 20 right now. 20 is that static level that people use as kind of a line. If we're below 20, we're not in a real fearful environment. Once we go above 20, we are in a fearful environment. Well, I changed a number of years ago, and I started also using moving averages, because using a static number doesn't allow for any flexibility with how these indicators can change. So I look at more of the moving averages, and yes, we're below the moving averages, which shows that fear is not extreme. But if you look at it from still being above 20, you would say fear is starting to get extreme. So I kind of take both of these together. The VIX, it really saw a decline. As the VIX went up, the VIX of the VIX went down, both on the bar chart and on the closing line chart. The Ulcer Index, because we had a pretty strong update, it turned down a little bit. And you have to say, there were other times when this turned down, and that marked a real change in the market climate. Really, if you look at this, we really haven't gone anywhere, because we were kind of working towards the lower end of this short-term sideways pattern, and now we just shot back up to the top part of that. And that's what you see in sideways, choppy environments where people aren't really, there's a real lack of conviction that can happen during those times. Let's look at the sector. Since we had an up day, discretionary, which has been getting hammered, it was up 2.9%. Real estate did well. Communication, another weak sector, as well as technology. They saw a little bit of love on Tuesday. And let's see, the only sector that was down was energy, and down less than 1%. So there were probably some people taking some profits there. Then here's our sectors going back to the all-time high. Energy is still doing well, followed by utilities. Staples had a pretty good day. In the rear view mirror here, we have technology in last place with communication and then discretionary. So a lot of the strength that we saw on Tuesday were in these weaker areas. Here's our tech sector chart. We were up 1.88%, but haven't really done much to improve the overall look of this chart. These semiconductors, which had a good day on Monday, also had a good day on Tuesday, and we're up another 2.19%, but they still have a ways to go to start looking better. As far as inflation, the CRB was down, but still is in an overall uptrend. And then the CRB compared to the S&P, it declined a little bit since stocks did well and commodities had a weaker day. And here's just the inverse of that same chart. Technical alerts, mostly positive. The S&P got back above 4,400. Let's see, the NASDAQ went above. First it went below 13.3, then it got up to 13.4, 13.5, 13.6. We had this NYSE bullish percent index that crossed above 50, and that's kind of strange because I thought that was generated yesterday. Canada still seems to be holding up fairly well right now. Then let's see, oil actually dropped below 105, and the dollar set now a 2-year high, not just a 52-week high, but what is that, 104-week high with how things are going right now. And I seem to be having some issues with my computer here. Intraday. And again, this is a newer chart where we started off kind of flat, but then boom, just took off right out of the gate. And then, we should have started right here on this dotted line. We went boom right out of the gate, shot up above R1, went above R2. R3 was like way up here somewhere, and we really didn't even, I calculated it, but I didn't put it on the chart. And this software is supposed to put R3 on the chart. We wavered a little bit as the day went on, but then we saw some more strength as we got closer to the close. We ended up getting above 44.6, and then actually, a little bit above 44.7. And then saw a little bit of selling coming into the close. So a pretty positive day, but we're back to levels where we've been recently. So this is just a good move with inside of more of a sideways trend. Here's how it looks on the daily chart where we were able to get back above the pivot. So that's positive. We do have some overhead resistance. If prices continue to go higher. But again, we need to see some more evidence right now. Even though volume did advance, we were still below average overall. We're now 6.97%, the way I calculate things, from the all-time high. So not in correction territory. And we just spent a little bit of time back here in March. That was the only point when we really went into correction territory. Otherwise, we've just been pulling back for the most part. Now, there are other indexes that have entered and are still in correction territory, but not the S&P 500 currently. Here's one of the new indicators just showing that we are still below the 200-day simple moving average, but it bounced up. But that feeds into our longer-term trend in that we are below the 200-day simple moving average. Growth versus value. Growth saw an advance where value saw a decline. Here's where we're seeing growth ticking up against value. Here is value ticking down against growth. Here's the NASDAQ 100. It had a pretty good day since it has a lot of large growth tech stocks in it. And here's the pure growth. I switched the order of these charts. Pure growth was up over 2%, where value it had a good day also, but was only up 1% in comparison. Here's the ratio between the two, where we still have a lot of work that needs to be done here. And this is also the ETFs showing this. That just shows that value continues to outperform growth. As far as our trend, we are still going down as far as the ADX. These two lines are coming closer together. That's making the ADX fall. Even though we saw an increase in buying power and a decrease in selling pressure, the red line is still on top. So this is still considered to be a trendless environment. Our Arun just hasn't really been showing us much right now. We continue with the decrease in buying power and selling pressure, and our oscillator overall is going sideways. No change on the decision point market scoreboard from yesterday's video. As far as our breadth, we saw an advance based on price as well as an advance based on volume. And if you watched yesterday's video, I pointed out a little positive divergence was that a couple of the indicators that we look at, they did not go up based on price, but they did go up based on volume. And that can sometimes be a leading factor. And that's kind of what we saw on Tuesday. Our advanced decline ratio has climbed back above 0 currently. New highs, new lows are still in a downtrend overall, even though we turned up slightly with our moving averages. Accumulation distribution was able to get back up a little bit further away from the 20-day moving average. Short term, we're back up and we closed just above the 20 for the exponential moving average. We still have the simple moving average above where we're at. We did see an advance with the 20 period moving average study that we do. These are stocks inside the S&P 500. With the stocks with their 50-day moving averages, we saw an increase in their 200-day moving averages, also saw an increase. And this is just a mess right now, but we were able to get back above the exponential moving average, back above the 50 simple, and see all these lines, they're all over the place. But we're kind of right into the middle of our spaghetti tree right now. MACD turned up a little bit, but is still negative. The Swinland Trading Oscillator did see an advance based on price and volume and slightly went above the 0 line. That is somewhat positive. McClellan Oscillator also switched back to being positive. The Stoch RSI, after giving an oversold reading, has now come back out of that, as has the Williams percent R. Force Index still negative, but showing some improvement. Intermediate term, we are right at the 50-period exponential moving average, having regained the simple moving average. And you'll see this on some of these charts. We're kind of in no man's land between moving averages, and I'll point that out as I go through this. This is somewhat positive. They tried to say, we hit the resistance. Well, we went right up to the 100-day exponential moving average, and then that's as high as we were able to go. So that instead of hitting R3 on our intraday chart, we hit a moving average, which kind of stopped things. But this is the 100-period moving average, and I only use this when we're in sideways environments. So I hadn't had this chart up for a couple of days. So since we came right up to this level and we're able to get above the pivot, I wanted to include that. The PMO still continues to be negative across the board currently. In our PMO study, a little bit of an advance with those PMOs that are rising, slight uptick with buy signals, and still flat to slightly negative with those that are above 0. The BPI put in a little bit of a bounce bar, and here's the longer term view. Moving average rainbow here, we're kind of getting back up into the middle, and it's getting really hard to see this. I have lots of different rainbow charts, but for a long time I was using this because it really represented the overall uptrend, and I might pull out some of those other rainbow charts to see if they give us any insight. The stochastics, this was one of the oversold indicators. It bounced up short term, is turning up intermediate term, is still declining long term. Summation index declining and just turned up ever so slightly based on price. And this is another potential positive divergence. We're seeing where volume is turning up with a little bit more strength right now. All of our momentum oscillators are still negative. So that's really adding to the backdrop of being more negative. The CCI, which had been extreme negative, is coming out of that based on 14 periods as well as based on 20 periods. The vortex, we saw a decrease in selling, but we also decrease in buying according to this indicator. But since the red line is on top, that is more negative. Our RSI, just barely above 50, both on the 14 and on the 9. That's slightly positive. Then here's one of the newer indicators. This is the balance of power. We're below the dotted line, so that's negative, but it turned up slightly. Here's the Connors RSI. It advanced and actually gave us a little bit of an advance after Monday. So I'm just going to keep watching this indicator over a period of time just to see if it gives us any good insight. Where we really pay attention is when we get to these high levels, and then if we're above or below the dashed line. So our trading systems, a little bit of an improvement across the board here. Based on the S&P, we now have an uptrend with the Elder Impulse system. Also based on the spiders, we're still negative with the SAR. Different charts, seeing a little bit of an improvement with the Heiken Ashi, little bit of an improvement with the Kegi, still negative, and actually drew an extra box with the Renko. 3-line break, also a little bit more positive currently. And we saw a nice green candle. But you can see this, what is that, 1, 2, 3, 4, 5, 6 trading day range that we've been in for a while now. No change in the point and figure chart. It's still coming up with a negative pattern of a high pole reversal, or high pole warning, I should say, where these X's in the middle are the pole, and then we drop down after that. And that could be a negative signal, but price didn't move enough to change this. Long term, we're still below the moving average. Both charts that we look at, the mega stocks were up over 2%, but still have a lot of repairing to do. Special K continues to, I get these two mixed up for some reason. It continues to go lower. So it didn't really pick up Tuesday's move with really any conviction. Moving average study saw an advance on the 50, 150, and 200. Fibonacci, we were able to come back above the 38.2% retracement level, so that could be positive. Looking at the broad market, here is the S&P, here is the mid caps, which appear to have had a little bit more of a breakout, as have these small caps. We want to keep an eye on these small caps. Remember, that was kind of the catalyst that took us higher back in the middle of March. So I looked at that chart, and it's not really telling us anything now, but we want to keep an eye on the small cap index. If it's having a good day, regardless of what's happening in other parts of the market, that could portend to positive things for the S&P. Then our Dow Jones Composite, it was up 1.66%. And the Dow Theory, the Dow was up, the trannies were up after just getting crushed, and even utilities were up slightly. FANG stocks were up 1.81%, but still have a long way to go to start to look more positive. ARC was up over 4%, so that saw a nice little bounce. Here's the Dow, and this is what I'm talking about, especially when we have the 50 and 200-day moving averages. It's like we're in the jaws of the spread between the two moving averages. We came right up close to the 200-day moving average. Didn't quite hit it, but we're kind of right in between those moving averages right now. With the diamonds, we've switched to a positive signal. And then we closed right on the moving average with the small caps. And we had a nice little breakout with the mid caps. We were able to get back above the pivot, and now we're in between these two moving averages. NASDAQ still has more of a ways to go. It was up 2.15%, but still kind of back to where we've already been not so long ago. NASDAQ 100, same thing. And we didn't quite get up to this moving average, but it's just more within this short-term range. The Vixen, it closed in about the middle of the chart. Even though we had a good solid update closing near the high, the Vixen was more in the middle. And the Qs are back to a neutral signal with the Elder Impulse system. And then this is another one. We're right in between the moving averages. The NYSE, which has been hanging in there, it's above the pivot, above the 50, but now the 200 is acting as resistance. The S&P 100 actually underperformed the rest of the S&P 500. This is also holding up with the Wilshire. We were right on the pivot, broke above that, above the 50, and now we're in between these two moving averages. Internationally, China's having some trouble, and all the other countries are starting to roll over, including the U.S. markets. Our all stocks were up over 1%, but still have a ways to go to show improvement. The non-U.S. index that we look at was down about 0.5%. And then the dollar, it's just going up. Can it get to 101? Can it get to 102? It's been really showing a lot of strength lately. And here's the weekly chart thus far. Oil was actually down 5% to close at 102.05. That could have given some impetus for stocks. Gold was actually down 1.38%. And silver, I'm sorry, looking at the ETF. The ETF was down 1.5% for gold. And here's a longer term view of that, where silver was down a lot more. It was down 2.64%. So we see some of these breakout looks, and then they just immediately roll over and just drastically go in the other direction. And that's what makes trading these markets based on trends very, very difficult to do. And then here's the longer term view of the silver ETF. Bitcoin got below 40 earlier, and then it was able to get back above. It's in the 41 range currently. And you can see here, they might be able to draw a trend line here, series of higher lows. You could even make a suggestion that we're seeing some higher highs right here. Other people have pointed out, are we trying to build a head and shoulder pattern where we have a left shoulder here, a head, and then some kind of a right shoulder? We'll have to wait and see on that one. As far as bonds, we got up over 3%. I stated in yesterday's video, I thought that might freak out the markets a little bit, and the financial media loves to talk about that. Well, it really didn't seem to make that big of a difference. And then our yields are looking a little bit more uniform because we don't have any inverted yield curves anymore. Now, that could always change, but at least for right now, those inverted yield curves are in the rear view mirror. And then this just shows how international rates have really been rising and bond prices have really been declining. And corporate bonds have also been declining with the current yield at 3.89%. And junk bonds were down just a little bit. And then here's the yield. We're up to 6.38 with the junk bond yield. And then this is another new chart where I'm taking junk bonds, which are high risk, high yield bonds, which are considered risky, but yet a lot of people get into those because they offer a better reward especially on an interest rate basis, but you're in danger of not getting those payments or even getting your money back for that matter. But when people need to go after some good return, they may get into junk bonds. And I have a ratio here of junk bonds versus regular bonds. Well, lately, junk bonds have really been outperforming This is the S&P up on top, because junk bonds tend to follow the S&P. So if the S&P is going up, junk bonds tend to also go up. But they've been really outperforming bonds, which has not been a difficult thing to do in a rising interest rate environment. Relative studies. Gold actually broke down over 3% with the ratio between it and the S&P 500. Energy, still, it was down, but is still looking like a stronger breakout. Here is energy against tech. Since energy had a weaker day, tech had a good day. The energy was down a bit, but is still in an overall uptrend. This is growth against bonds, because we saw growth stocks do quite well and bonds not do well. We're seeing what could be a bit of a breakout here, but we need to see follow through. Here's tech against the S&P. Yeah, it was up 0.25%, but it needs to really show some improvement if we're going to get back to a stronger growth environment. Here's the tech against the 10-year yield, where tech had a good day. Interest rates were also up, so the ratio was little changed. And then this is what we're also watching as interest rates go up and tech stocks go down. Because they moved together on Tuesday, we saw a little bit of a decrease in the inverse relationship here. I just want to keep an eye on that one. Then the 10-year against tech. This just shows that the 10-year rates, even though they declined a little bit, have really outpaced the tech sector. Here's discretionary against staples, where discretionary had a bit of a bounce. And then the S&P has really underperformed the rise in interest rates. Here's our low volatility stocks. They were up over 1%, so they participated in the up day as well. But when you compare them to the rest of the S&P, they actually declined a little bit. However, we have a golden cross, and they are still in an overall uptrend. So what's our outlook for Wednesday? The technicals are negative, but can the bounce continue? That's what we're going to be watching for. The markets remain in a trendless intermediate term range that goes all the way back to the beginning of 2022. We have this daily back and forth between growth and value. The markets are really watching interest rates as well as oil prices. And then we have the supply chain issues that is kind of coming out of China right now. On Wednesday, we have existing home sales. That'll be coming out, and the weekly MBA mortgage applications index. These are more real estate focused. So we don't have a real heavy week as far as economic reports. And then all the different geopolitical events, the things going on in Russia, Ukraine, China, the supply chain, inflation, interest rates, oil. Lots of things to be focused on right now, and any one of these can come to the forefront at any time. So what are our scenarios for things to go down from here? If interest rates keep on going up, the typical scenario has been that interest rates up, stocks down. We didn't see that on Tuesday, but if that continues on Wednesday, that could drive prices lower. We also have some real earnings reports coming out. And a lot of times when you see a run up before an earnings report, that's buy the rumor. And then once the report comes out, the stock just tanks. That's sell the news. So the markets are going to kind of gyrate around as we get some earnings reports. And our technicals are still negative overall. We didn't really do much to change things. Okay, what could go to make things go up from here? We have a positive backdrop after yield curves have reinverted. That's still on the table. And that will be on the table for quite a while because this can take some time to develop. The short-term oversold bounce. Can the momentum continue? That's what we'll see on Wednesday. The moving averages and pivot points, they may provide either support or resistance, and we saw that in some of the charts today. We're still with scenario number 3. We're still below 20 with the ADX. And it's continuing to decline. And what we see kind of goes against what we saw as far as price movement. But What I'm talking about is we have a lot of bars in a row where, yeah, we might have had a strong up day yesterday, but it just shot us back into a range that we've been in for the last number of trading days. So what's our conclusion? The S&P continues to be negative. Short term, it's negative, but it bounced from being oversold. Intermediate term, it's also negative. Our oscillators are negative. We were able to gain that 50-period simple moving average, and we're right above the 200 exponential. Long term, we are negative because we are below the 200-day simple moving average. And then here's just a look at the videos that I also post. So thank you very much. Have a very good Wednesday, and I will look to prepare the next report after Wednesday's session.